A very good evening, everybody. Welcome to part 2 of the Phillip Futures two-part webinar series held in collaboration with CME, exploring trading opportunities in CME Grains and Oilseeds. I'm Ming Hui from Phillip Futures, and speaking to us today will be professional proprietary trader, Mr. David Ng. Stay on to hear him share the basics to spread trading, some spread trading strategies, and how you can spread trade agricultural futures effectively. Before I pass this on to David, I'd just like to inform you that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a Q&A session towards the end. And now, without further ado, let's have David speak to us.
Hi, thank you, Minghui, for the introduction. And thank you for having me back on the second part of the two-part series. Just before I start, just like to thank Phillip Futures as well as CME for hosting this platform. I believe it's very timely. I think in the first part series, for those who have attended in the first session, I do touch a lot on trading agriculture product, especially corn and soybean, in terms of the outright contract perspective. In this part series, I'm just going to cover mainly on spreads. There's a common notion among the marketplace is that when spreads are only reserved for professional traders or for those institutional desk traders who knows more about the market. I'm just going to debunk that notion. I think that notion is false. In fact, if you just look at the trend nowadays in the market, be it in the agriculture space, be it in the indices space, a lot of traders are slowly moving into trading spreads as part of their overall strategy. So if you are someone new to spreads, I think it's a good time to start looking at spreads trading. Later on, I'm just going to touch a few benefits of trading spread. But I believe as a retail trader, or even in fact you are not a professional trader, the journey to spread trading is not going to be a difficult one if you understand some of the key principles that underpin the spread trading overall. Okay, so let's just start. Just before I start, a very usual risk disclaimer, just to disclaim any presentation materials here is purely for educational purpose. So any trade recommendations, do take it with a pinch of salt and do consult your brokers for further inquiries or even for further recommendations. So I think the main agenda today is I'm mainly going to cover on spread trading. And I think in reference to this is that I'm looking at the corn and soybean as well. There's a lot of types of spread trading in the market. I'm just going to cover that in general as well later on my slides. And I'm just going to cover a little bit on trading strategy that you can use when you look at spreads. And obviously, as part of any trading plan, any trading journey, whether it's on the outright contract or whether it's on the spread contracts, you really do need a trading plan. And you need to establish a trading plan before you start your trading journey. And I think that's one of the key ways that you really need to employ, especially before you start going into the market. So just a brief recap on what I've highlighted in the first part series. I think in the first part series, I mainly talk about fundamentals. When you trade grains product, especially especially the CME grains market, it's very important for you to analyze the fundamental perspective of some of the key products, especially corn, soybean, and wheat. And obviously, supply-demand dynamics is always a very key factor when you look at fundamentals. Stocks to use ratio is also another key important parameter. It's actually a barometer on how whether it's the particular grain market is pretty much in excess supply or in a lower supply market, and obviously it's going to have impact on prices. And as a trader in the grains market, you really need to be aware of the reports that's coming out on a timely basis. You have weekly reports, you have monthly reports. Those reports do have an impact on market. So if you are trading grains market, it's very important for you to keep up to date and on some of the crop reports. You can always get those information from your broker, especially from Phillip Futures, or you can even get those information on CME website. So as a trader, it's very important for you to be informed on basically the supply and demand dynamics, which USDA comes out very regular reports, especially you have crop progress reports which come out every weekly. You have also planting intentions. All these two are key crucial reports, especially when you're looking into harvesting periods for a particular grains market. Weather is very crucial because weather will have a very distinct impact on prices. If you have adverse weather scenario, like you have extreme events like La Nina or El Nino, this could have impact on prices. So it's very important for us to look at weather as part of the equation whenever you want to assess the fundamental dynamics of a particular crop. So government policy is also another perspective which we need to keep in mind whenever you are looking into trading the greens product. So just to show you the crops calendar again, because it's very important for us when you look at spreads, grain market in a spread basis, it's very important for us to take note when are the period of the harvesting and planting cycle for a particular crop, because that will actually distinguish which particular month that you should be going long and which particular month that you should be shorting. So it's very important for us to distinguish which are the period of harvesting and planting cycle for a respective crop. So say for example, the US corn, planting seasons are always starting from April to June. Same goes for soybean. Soybean is a bit later, a month later. And harvesting usually done towards the third quarter and the fourth quarter of the year. Wheat, we have two categories. We have the spring and the winter wheat. So obviously the name denotes when is the planting season. Winter wheat is usually planted in the winter, which is towards the end of the year. And spring wheat is usually planted in spring. And obviously, on the last series, I also did mention soybean, US, although it's a major market, we also see the major rise of South American beans. And Brazil and Argentina, the crop cycles are slightly different from the US crop cycles, which in fact that if you look at the crop cycles for the South America soybeans, it's actually complementing the US crop cycle. So whenever US is going into a planting season, the South American will be probably going into the harvesting season. So in a way, they'll be keeping in a continuous supply of soybeans into the market. So with that in mind, with the crop cycle calendar in mind, whenever you are trading a particular crop, it's important for us to identify which are the particular months that is coincide with the planting season and which are the particular contract months that coincide with the harvesting season. So this is a sample report of a USDA which come out on a monthly basis. And as a trader on a grains market, you really need to take note on when the release of such reports, because on that day, you will definitely see huge price fluctuations. So if you're a trader that you don't want that kind of volatility, you should avoid on that trading on that day. And obviously, with huge volatility, is always an opportunity for a trader in the market. So it depends on what type of risk profile of a trader you are. But obviously, report dates are very crucial for if you are trading on the grain markets. So on the right, I have the table of the next year calendar dates for the we call it the World Agriculture Supply Demand Estimates, which is a very key crop report released on a monthly basis. So if you are someone that is trading in the market, do watch out on those dates. So let's get on to the basis of the day. So spread trading is something that is, it's very common in the market nowadays, because there's a lot of information that you can gather. There's a lot of knowledge that you can gather. The key thing is that when someone that's new to the market, if you are trading on majority of the time on the outright contracts, which is what you're just trading on a single month, single contract, single product, then you tend to be familiar with that particular space. But when you move into trading spreads, it gets a bit complicated. I think the reason of the complication is because when you look at spreads basis, it's always involved two contracts and it's on opposite positions. So say for example, if I were to say today I want to do a corn calendar spread, in futures market, you have multiple series of contract months. So if I say, for example, I want to do a March 2021 corn contract and I want to do a December March 2021 contract. So it's basically two contracts, but you have an opposite position. I'm going to illustrate in certain diagrams to make the understanding of principle easier. But ultimately and essentially, spread trading is all about trading the different price differences between two particular, whether it's on the same contract but different months, whether it's on the different commodity, or it could be the same commodity but different exchanges. So I'm just going to share with you some different type of spreads that's available in the market. But keep in mind, I think spreads essentially is just looking at the price difference between two particular contracts or months for the particular instruments. And I think as a trader, we are very interested in the price difference. There's a lot of benefits of trading spreads, which I'm going to highlight later. But trading spreads is also part of a risk management strategy, and it's a lot of institutional traders are using it because it's a method for them to hedge their respective positions. But again, it's available for retail traders, and as a retail trader, we can participate in spread trading as well. Now, I want to skip a little bit of jargon, but it's important for us to understand the principle that underlines the price differences between same commodity but different months. So there's a technical term for it. It's called carrying charges. So if you look at a particular crop, for example, say for example corn, if you notice that as you go further out in a month, those prices are going to get higher and higher. There's a reason for it. The reason being is because as we go towards further month into the year, there will be certain charges on an intermonth basis that's applicable. Reason being, grains are storable commodities. You can store it. You can obviously, when you store certain commodities, there's always fees involved. There's storage fees, the handling fees, there's in fact insurance. So all these are costs. So if you are a producer in a particular commodity, all these are added costs into you. So if you want to store a particular crop for, let's say, a period of 2 months, so you are incurring a 2-month cost period, and that's going to reflect into prices. So it's very natural for future contract prices, especially future contract months, to display higher prices, because that will reflect the cost of storing the particular commodity to the particular date. So in a normal market, in a normal market situation, we normally see future contracts usually traded on a higher basis compared to, we call it to the nearer contract basis. So there's a technical term for it, but I think it's important for us to take note. There's always a price difference. And the reason underpin the price difference is basically due to carrying charges. Because you're dealing with a crop, you need to store it, there's cost involved, and therefore they should reflect a price difference between different months. So I think in this charge carry cost, or what we call it the cost of carry a particular commodity from 1 month to another month, it can be calculated theoretically. There's a lot of traders who calculate theoretical cost of a particular crop, but again, market has a lot of supply and demand dynamics, and it can influence the calculation. So there'll be probably a series of period where you see spreads tend to deviate from a theoretical cost of carry charges. There's a particular reason to it, but as a trader, we shouldn't be too focused on calculating what is the value of the cost of carry, or what's the theoretical value of cost of carry, because eventually this spread or cost of carry charges will tend to deviate. The actual spread in the market is still being influenced by the supply and demand dynamics of the market. So it's very important for us trader to be aware that calculating theoretical cost, and if we see any deviation, it should be a good entry, trading entry. But we have to take note that ultimately, market doesn't always reflect the fair value. They're bound to have certain elements and dynamics that the market is trying to factor in. So as a trader, we have to be very dynamic in our approach. No, we cannot just fix to just calculating theoretical value and therefore we arrive a conclusion. So I think this is something that as we head along, if you are trading the market, it is a principle that for you to take note, especially you're trading the commodities market. So there's 3 types of spreads in the market. I think the commonly used is always what we call the calendar spread. Now, calendar spread is basically you're talking about the same commodity but using different months. So say, for example, if you are trading corn, you can obviously trade the March contract together with the December contract. So in this example, we are calling it a calendar spread trading. Now, obviously, we have also another type of spreads. It's called intermarket spreads. So corn and soybeans are two related products. And in fact, as we go on to the series, to later on the slides, corn and soybeans are annual crops. So basically, they have a cycle. And as a planter, when they move into the new cycle, they always look at both the respective prices. So if soybean prices are way higher than corn, there's more incentive for the farmer to plant soybean. And in that case, it's sooner or later, the supply of soybean is going to get higher. And that will depress price. And vice versa, if you're planting lower corn this season, it's going to reflect higher price next season because you're going to have a lower supply of corn. So these dynamics is also interrelated, and this is what we call doing an intermarket spreads. So basically is that we are trying to relate a different commodity here, but using the exact months in both the commodities. So an example could be you're pairing July corn with July soybean, for example. And there's a third category of spread, which is called the interaction spread. I think this commonly denotes for the wheat market. You have obviously the Kansas wheat and you have the CME wheat market. So both have a slight price difference. There's a spread to it, and some traders do look at it to trade it accordingly. So this is an example of inter-exchange market spread. So we have a Kansas wheat and a CME wheat. So you can see there's actually a price gap difference between both markets. Do take note, it's the same instrument. It's still a wheat market, same specification, but there's still a spread to it. So this is what we call inter-exchange market spread. So coming back to the essential of spread trading. Now, spread trading always takes two positions. So one position could be a long, could be a short. And the second position will be an opposite of your first position. So say, for example, in the position one, you're longing a particular month, which is referring to calendar spread. And the second position, you could be shorting a particular month. Now, there's a rationale to it, meaning that the reason you're doing this is because you're hoping that eventually both the prices in the first position and second positions will tend to go wider. And if it does go wider, you are making a profit. Now, vice versa. If the first position you're taking a short position and the second position you're taking a long position, you're hoping that eventually the spread will tend to narrow. So basically the rationale of doing a spread is you're taking the relative difference between two contract prices or two different instruments, and ultimately you are just trading on that differences. So that by looking at spread and by us doing a two contract on a simultaneous basis, in a way we are lowering our risk profile, and that gives a lot of advantage to a trader. I think in the next slide I'm going to share with you how much of a risk that's lower compared to doing an outright trading when you're doing spreads. And obviously, lower risk profile is definitely something that's very attainable, especially for traders who are looking for hedging a particular portfolio or lowering down the risk of an overall portfolio. So spread trading, it could be an additional benefit when you're trading spreads. And obviously, if you compare to flat prices, which is referring to outright prices, spread prices tend to move less volatile. Outright prices usually are very volatile, especially as I highlighted earlier, if you are going into a report date, now that's where you get very crucial. So that's something for us to take note. Secondly, I think if you trade spreads, normally your required margin is lower. Reason being is because you are taking two positions, both of them is in a way cancelling each other because you have one long and one short position. So the required margin is in fact lower. Certain products, grain products especially, it usually ranges about 15 to 30% of your normal outright margin. Do speak to Philip Futures for the current margin, especially for spread margins. But in general, when you are trading spreads, it's usually require a lower margin. And if you look at it in certain ways, if you look at spread and compare to outright trading, spread trading does present you a clearer signals in certain scenarios, and in fact it responds quite well to certain market indicators as compared to outright. As you know, outright is where a lot of traders put their attention to. When it comes to spread trading, it's slightly different dynamics, slightly different scenario. And fourthly, spreads do reflect certain seasonality, as every crop, whether it's corn, soybean, or wheat, there's certain periods where it tend to be weaker and certain period where it tend to be stronger. So you can relate a particular spread by just focusing on those bases. Now, given that it's a lower margin and with a lower volatility, so obviously when your rate of return is compared to your capital that you're putting in, it's going to be higher because of the lower capital requirements. But again, like I said, it's always double-edged thing when it comes to leverage. You can make good returns, you can also lose the same amount of money. So it's always very important and very vital for you to deploy proper risk management tool, even when you're trading spreads, given the lower risk profile. Now this is a bit technical. Spread can also be used to roll over a position. So if you are holding, because since when you open the calendar spreads, you are holding two different months positions. So if you want to roll over a certain position, or because you want to have a longer view, because each month has an expiry of a particular date, and you want to express your view in a longer term basis, you can actually roll your position by using a spread position. I'm not going to go too deep on this, but it gives you the flexibility from turning a spread position to an outright position easily. So this chart here just to illustrate my point. So you can clearly see the chart on the left is a corn March 2021 contract against a December 2021 contract. So you can see there's a price difference chart. On the right is purely an outright chart of the March contract. So in the first series, I used the average true range as an indicator of the risk management tool. So you can clearly see when you compare the ATR value of a spread contract against an outright contract, ATR values are probably about 5 cents on the spread March against December. If you compare outright, you're looking about 10 cents. That's roughly about 50% less volatile compared to the outright contract. So against this shows that spreads has lower volatility because it's actually comparing two different contracts, different months, as compared to one outright contract which you are exposed to the full swing of the market. So trading spreads has a lot of benefits, and I think the key benefits is always you are looking at a lower risk profile. So that's on the benefit of spread. Now, when you are trading spread, it's important for us to take note certain key technical terms or jargon. But don't be too afraid with that. Importantly is that you just have to be careful when you look at the spread charts to see where are the areas of opportunities for you to enter a particular trade. But before that, I think it's when you are building that kind of foundation to trade spread, it's important for us to build the key fundamental dynamics that underpin some of the key structure of the market. So I think the first structure on when you are trading spreads, you need to know the term, what we call the term structure. So what you can do is that if you look at corn or soybean, you look at the period of contracts that they have. If you plot those prices onto a chart, that's what you get what we call the term structure of the market. It's basically to tell you where are future prices indicating. Is it going to be up? Is it going to be down? Or is it going to be sideways? So there's two technical definition for how we term the market structure of a particular product. One is what we call a Contango market. Now, in grains market, a Contango market is what we call a normal market. So like corn, soybean, or wheat, obviously future month prices going to be higher. What's the reason? For the simple fact that for me to carry a particular product from this month to next month, it's going to incur storage costs, it's going to incur insurance, it's going to incur handling fees. So it's going to be more expensive. Obviously, market is dynamic. Things can change. But in a normal market, in a normal situation, this is what you could expect from the market. And when you see future contract months are higher than your current month, that means practically there's a term for it. We are in a Contango market. Because the reason that those farm month prices are higher is they are trying to reflect the storage cost that's applicable to a particular product. Now, there's always in a reverse scenario, in an inverted scenario, we usually term it as a backwardation market. Now, in this market, it's unusual for your current contract to be more expensive than your future contract. So what this means is that, say for example, corn, the January 2021 contract is going to be more expensive than March 2021. And in this market, this is what we term it as backwardation market. Now, there's a couple of scenarios that underpins this kind of structure. Firstly, it's always attributed to fundamental dynamics. And usually it could be attributed to supply dynamics. You are facing a bad harvest or probably a weather scenario, and that will really push up front month prices. We have seen that just 2 months or 3 months ago. We're seeing corn rally, we're seeing soybean rally because we are expecting a supply change, and that actually causes the front prices to be much higher than the farm month prices. So in this market, it's what we term as a backwardation market or inverted market. Now, this scenario will not last long because as the front month prices gets higher, a lot of farmers are very incentivized to release a lot of stockpile as they can because there's no incentive for them to keep or to store their particular product. because the current contracts is going to be rewarding them with higher prices compared to the farmer prices. So eventually the curve will tend to shift from a backwardation to back to a normal contango market. And it's very important for us to take note. Term structure for commodities, they can change, and they do change on a day-to-day basis. And as a trader who are looking to the spread market, it's important for us to identify when is a change in term structure, because that's usually be a turning point in a particular spread. And if you have to be very sensitive to change in structure, because that could have an impact on the price difference, and ultimately it have an impact on your spread prices. So just to illustrate the term structure, this is term structure of soybean market. So you can clearly see the first 3 to 4 months current contracts are quite flat. That means the price change between those contracts are quite thin. In fact, the spread probably could reflect just only a full cost of carry. But as we head over to next year, second half of next year, that's where it gets a little bit interesting. So next year prices are going to be much lower. The reason being is indicating that the market of supply is coming to the market next year. Probably the market is expecting there's no adverse weather impact. Supply is going to be good. Prices is going to come down. So next year, if you look at it, the term structure is indicating you a backwardation market. Okay, whereby your farmland prices are actually going to be lower. So like I said, this is it's an inverted market. It's not normal, given that if you look at the soybean reports, they were seeing from the USDA, from the World Agriculture Supply and Demand estimates, is indicating you that we're going to have a smaller supply of soybeans, and that's the reason why you are seeing fund prices is higher than your back month prices. Now this is something that's it won't last long. Eventually, supply demand dynamics is going to be balanced. Then the term structure will tend to change, and that's where if you are trading spreads, you have to take note. Now for corn, this is the term structure for corn. Corn is slightly interesting as well. You can clearly see the front months are showing you a contango market, which is a normal market. So farmland prices are the first few farmland prices are looking quite positive, which is higher than your current month price. But as we head over to next year, especially to the second half of next year, that's where things start to change. So again, I think market is trying to factor in a higher supply in the market next year, and we probably would see a backwardation market as we head on longer term into the structure. Now, corn, if you look at term structure, there's a unique point. If you look at every month especially the month of July in corn, you can always see prices tend to peak. Then after that, the prices will tend to fall. If you coincide with the planting season and the harvesting season, July is pretty much the end time for the planting season for corn, and it's probably the beginning of the harvesting season. So market, before they go into the harvesting season, prices will tend to adjust because supply starts to come on stream into the market, and that's where prices will tend to be adjusted. So understand the concept. Contango market is what we call a normal market where future prices is going to be higher, and the reverse of that, a backwardation market, is where your future price is actually lower. Now in grains market, a contango market is what we deem as normal market, but obviously there is certain dynamics, especially with supply and demand. A market can be a backwardation market, but again, this won't last long because eventually the supply and demand dynamics is going to be balanced out the overall term structure. So with that principle in mind, let's move on to how do we actually position a view when it comes to spreads. So there's two ways of having a view in the spread market. One is what we call a bull spread, and another one is called a bear spread. Now, in a bull spread market, is basically we are always referring to what we call the front month or near month and the relationship to the further month. So say for example, in a bull spread market, what we are doing is you're buying the near month contract and selling the further month contract. So say for example, a very common calendar pair spread for soybean is always the July and November pair. So if you are bullish on that particular calendar spread month, you will be taking a long position on July 2021 soybean, and you'll be shorting a November 2021 soybean. So when prices rises, the long contract usually will be profitable because, you know, price rise, you're having a long position, you are in the trend. Now, however, you're also having a short position in the November contract. So that position will normally attribute to losses. Now, the key thing about doing spread is that the understanding of spread, because you're having a long and a short simultaneously, you're only concerned about the difference between both contracts, the price difference. So eventually, what you're hoping for, as long as July 2021 soybean contract is rising faster than November contract, you are pretty much, your profit from that long contract will more than subsidize your losses in your short contract. Because in general terms, when you see when soybean markets generally tend to trend, all your contracts, all different month contracts will also tend to rise. So when you have a short position, the other leg of a particular spread pair, that usually will attribute to losing money. But in this, the rationale of doing a spread is because you're hoping that the spread between two contracts will stand to widen. You probably do a bull spread by taking a long position on the near month, and with that, hopefully the profit will subsidize the losses that you're probably going to incur on your short position. So bear spread is a different scenario. Bear spread is you're hoping that eventually the spread will narrow, and that's where you're going to be selling your near month contract and buying a far month contract. So, for example, the same example again, if you are bearish on the July and November soybean contract, you should be shorting the July 2021 and buying a November 2021 soybean contract. So in this example, it's actually a bear spread example. So in what scenario you should be bullish and in what scenario you should be bearish, especially when it comes to spread. Now, when you look at calendar spread, it's talking about a 2 months price difference. One is always referring to your near month, another one is always referring to a far month. So in the previous example, I was talking about July and November soybean contract. So July is always referred as a near month, November is referred as a far month. Now, if you have a view that the near month is going to go up and the far month is going to come down, you should be buying a calendar spread. So in this scenario, you're buying a bull spread. Now, if there's also a scenario whereby if both contracts are rising, but the near month is rising faster than your far month, again, you also will be buying a calendar spread. Reason being, eventually the spread between the prices between both contracts will widen, and that's the rationale for you to enter a bullish calendar spread. Now, not necessarily bullish calendar spread only attributes to a rising market. It can also attribute to a downtrend market. Now, in the downtrend market, if your near month is coming down slower than your far month, technically it's also the gap is going to be wider as well. So in this sense, you also will be buying a calendar spread. Now, in a reverse scenario, whereby you're thinking that the spread will tend to narrow eventually, in this case, you'll be doing a bear calendar spread. So what examples that you're going to be doing that? If you're noticing that the near month is coming down and your far month is going up, the spread tend to narrow, you should be selling a calendar spread. And if you are in the downtrend market, your near month is going to come down faster than your far month, you again is going to be selling a calendar spread. And bear calendar spread, it doesn't only attribute to a falling market, it can also attribute to a rising market. And when that happens, is that your near month prices is going to rise slower than your far month prices, or far month prices rising faster. So in that example, you also will be selling a calendar spread. So eventually, when you are buying or selling calendar spread, especially when you're selling calendar spread, you're hoping that the gap to narrow, and you're buying calendar spread when you're hoping the gap to widen. So essentially, that's the dynamics that you're doing with. So just to show you, to illustrate an example, this is just the July 2021 against the November 2021 contract, soybean contract. Both are outright prices. If you overlay them together, you can clearly see there's a gap between them starting around August or September. And after that, you can clearly see that the gap gets wider and wider. So in this example, when both prices are rising, but one contract, especially the near month contract, is rising faster, you are actually going into a bullish spread market. So what you are thinking to capture the trend, you should be buying the near month and selling the farm contract. And this is what we call a bull spread example. Now trading spreads, you must always relate historical perspective, because in spread trading, spread tends to range for a period of time. So if you are a range trader, spread trading is actually very beneficial. But do keep in mind, once the spread breaks a certain range, especially the long-term range of the market, it usually be a very big rally, whether it's on the upside or downside. It's unlike the characteristics of an outright contract. Spread tends to range, and that's where, if you are someone that likes to arbitrage the market, or if you are doing something like a mean reversion strategy, where over the longer term, prices tend to revert back to its mean, spread trading can be very applicable in that sense. But it's very important for us to identify the trading range of particular spread based on a historical perspective. So if you look at this example, the soybean July and November calendar spread, it has been trading between the 20 cents range for a very long period of time. In fact, I think for the whole 1 year, since I think July 2019 to September 2019, it was been trading between the 0 to 20 cents range. Obviously, there's period where it goes negative. That where we call the negative carry charge. But take note, when it hits towards the early part of September, that's where the spread dynamics changes. It broke out with 20 cents range, and it has a massive rally up to 50 cents and to a dollar range. So that's actually tremendous rally in terms of the spread market. The reason being the fundamental has changed. So it's very important for us, if you're doing spreads, even though there's a given range based on historical perspective, it is important for us to be sensitive whenever prices tend to break away from the range or break out from the range. Usually it signifies there's a significant change in terms of fundamentals. So that's on soybean perspective. Now look at corn. Now corn, the March and December pair calendar spread has been a very active contract where a lot of traders refer to. Now in this contract, you can clearly see if you overlay with the outright contract, the corn outright contract, it tends to display a similar pattern. But again, do take note that spread tends to revert back to zero, where it means that there's no cost of carry. The farm month price is going to be the same as your front month price. That's where the tendency of spread tends to go. But eventually, spread, if it's a bullish market, it can go far beyond the zero value, and that's where you if you are trading the spread, you are facing a trendy market, and when spread trends, it trends massively. So this is something that you have to be aware when you're trading the spread dynamics. It's slightly different from the outright contract, and it's actually applicable for certain type of technical indicators when you are doing spread. Although for when I'm doing spread, I use a lot of market profile, which when I'm doing outright, I'm not doing market profile at all. But spread, it does help me to identify the range of a particular spread pair. So in this example, you can clearly see the March-December pair, it has been trending down since the beginning of the year. Reason, if you look at the outright corn contract, is also a plunge because we have COVID crisis early part of this year. But then again, we saw the recovery, and that again was displayed in the pair spread. You can see prices starting to rise back in early September. So if you are doing spread, it's important for us also to identify the trend on the outright basis, because that will have a significant impact on your spread basis as well. So this is a contract table for the soybean futures contract. So you can clearly see it's spelled, the contracts are being spelled in Jan, March, May, July, August, Sep, and November. So if you are trading spread in particular, the grain spread market, it's very important for us to understand the meaning of an old crop and new crop. Now, the market convention for soybean is that November is always termed as what we call the new crop contract. So November contract is what market term as new crop. Contracts that's not November contract is always termed as the old crop contracts. The reason, basically, if you look at the planting season and the harvesting season for soybean ends around November, and planting season usually starts in early part of the year. So when the harvesting season has pretty much done, that's where you get all your new crop going to be. And other than those months that's not November is usually what we term as old crop. So if you are doing calendar spread, it's very important for us to take note, which particular season that you're pairing with. So for example, the soybean, the July-November pair has been very active. Reason being because July is in the old crop month and it's the last month for the planting season. And November is where you start to harvest. So it tends to get very volatile as we approach closer to the planting season. So I think these are some of the dynamics that you have to be aware of when you are trading the grains market. So soybean contracts is actually listed in such a way that most of the contract months are actually coincide with your planting and harvesting season. So same goes for corn. Now corn, December contract is always signified as the new crop contracts, and other contracts as not December contracts are classified as old crop contracts. Now, soybean calendar spreads, the July-November pair has been very active. This is basically on Philip platform. You can engage with some Philip representative if you want to find out more. The calendar spreads is listed on the exchange. It's exchange listed spread. So you can actually get those quotation on the Philip system. Same goes for corn. Corn, I think the March-December contract has been a very active calendar pair spreads. So if you are thinking of doing the particular corn calendar contract, you should be looking at the March and December pair. So here just relate that corn and soybean has actually interrelationship between both products. Obviously, it's a very closely positive relationship. So whenever you see a rise in prices of soybean, you should see a rise in price of corn as well. Now, I'm just going to briefly touch on some of the technical setups that I use when I look at spreads. So obviously, the first thing you need to do is to identify the overall trend of the market. One is by visual. So when you see higher highs and higher lows, normally it's an uptrend market. Lower highs and lower lows are normally a downtrend market. So establishing the trend is the first thing that you do. So you can clearly see that once you see a higher high, higher lows, that's usually pretty much an uptrend. Now, here I indicate the box range, basically the range of the market for a long period of time. Now, this is where you have to be careful because, like I said, spread tends to trade in a very tight range for a long period of time. But once it breaks out that range, it's going to be a big rally, whether it's on the upside or the downside, because usually it tends to signify that the fundamental has shifted. The outright contracts has actually also been going to be into a rally. So, when you're trading spreads, it's very important for you to identify the range. So again, if you look at the soybean July 2021 and you look at the July-November pair, you can clearly see that around late August is where the start of the rally is. So the spread and the outright movement is very similar, especially you're trading a July and November pair. So if you are trading soybeans on the particular pair, take a note of how the outright contracts has been performing as well. Now this is the corn May and July contract. Again, I like to highlight usually when you spreads tends to do in a range, in a very tight range for a long period of time. And in that sense, you can establish the support and resistance level. So I'm bearing any unforeseen circumstances changing in fundamentals, you should expect that the range of the spread will be between the resistance and support level for a period of time. Unless fundamental has changed, that's where you need to be very careful. But other than that, if fundamental has remained balanced, supply and demand dynamics are still pretty much balanced, you should expect spreads to be trading between the resistance and support level. So this is, if you look at the corn May and July spread, you can clearly see resistance is about 0. And you look at the support, I think historical support has been always the -7 cents for a long period of time. So obviously, if it does break above 0, that usually signifies there's a change in the fundamentals, and that's where you have to be careful. Now, I think the last example when I was presenting on outright technical perspective, I didn't touch on volume profile because I don't use volume profile when I do outright. But when it comes to spread, I actually do employ volume profile. Now, volume profile is important because it does tells you where the market participants are heavily trading at a certain price level. and that's usually be a support and resistance level. So in this May-July contract, you can clearly see, the strong resistance, or now it looks like a resistance level is around the zero value. But if we look at the downside perspective, another key support area is actually around the minus 3 cents level to minus 4 cents level. So that's indicated by the volume profile. So if you are trading spreads, it's important for you to distinguish where are the key price levels through the volume profile as well, because that will give you an indication where the market is heavily transacting at a particular price level. So soybean, this is May and July. Again, you can clearly see the market is also doing quite a tight range between minus 7 cents to positive 7 cents. And again, zero has been always the parity. So whenever you cross the 0 point, that's where prices will tend to be what we call revert back to its mean. And that's where opportunity to take a trade usually present itself. So again, here I deployed the volume profile. So you can clearly see the bars as heavy in volume is usually indicating where market is transacting at a particular price. And if you look at it, it's usually the key support areas for a particular spread pair. And as we hit above a certain range, if you are hitting the resistance level, that's where you should also accompany by the volume profile, because that will show you how volume has been for a particular spread. So besides looking at volume profile, besides identifying whether the trend of the spread is up or down, it's important for us also we can incorporate moving average as part of the strategy. So here again, same as the outright presentation, I also use a 9 and 20 days parameter for me to actually gauge where the spread is actually going to hit to. So again, moving average crossovers, you could deploy such strategy whereby bullish crossovers always happen when the shorter term cross above the longer term, and vice versa. Okay. So again, you use volume profile as a dynamic to determine where are the common support and resistance area. Now, I think another key important setups when you're looking at spreads is to use the Heiken Ashi. I did mention this in the first part series when I was doing the outright. When it comes to spread trading, you can also use this, but keep in mind, spread doesn't trend as much as outright. Outright trend on a bigger perspective. So, but Heiken Ashi does give you certain indication when spread starts to change, when the trend or the spread starts to change. So it does give you some basis of understanding whether you're in an uptrend or whether you're in a downtrend. So it's trying to reinforces the point, whether you should be bullish on the spread or you should be bearish on the spread. So now uptrend in Heiken Ashi is usually highlighted by your colored green bars, the sequence of colored green bars. Downtrends in Heiken Ashi is usually highlighted by the sequence of red bars. Sideways market is usually you don't see any clear red or green bars, and usually that's a sideways market. Now in spread markets, you tend to see a lot of a sideways market because it usually tends to range between a very tight range. But that's where an opportunity comes. If you are hitting the extreme points, whether it's the resistance or the support range, that's where usually points you a possible entry positions. So example of Heiken Ashi, how we use that in spread. So if you see series of colored green bars, it tends to tell you that the market is trending on the upwards. If you see a sequence of red bars, it's usually indicating you that the market is actually coming on the downside. So that's indicating you the trend of the overall spread market. So if you look at, these are all applicable on the corn spread market. This is basically looking at March and December. Now, the reason I use March, December, and July North for soybean is because of the volatility of the particular spread pair. You can obviously use other months. You can pair it with other combination. But do take note that certain combinations, certain spread months can be very less volatile. In fact, the range is very tight. So there's not much opportunity if you're thinking to do range trading. So March, December pair gives you a bit more volatility and it's a little bit more trendy in certain sense. So if you look at this chart, for example, you can clearly see that the spread has been trading in a range, but it's actually quite trendy. You can see the downtrend and uptrend most of the time. Okay, and this is soybean July and November. Now, this is a particular spread pair which is very active recently because it broke the long-term range and it's actually on a bull run. it's reflecting the outright performance as well. So I think in this example, if you look at Heiken Ashi, it's showing you a very strong uptrend. Obviously, there's a period of retracement, but no overall trend is still on the upside. Now you can accompany all this analysis with volume profile, because volume profile will indicate the level of price where it's quite significant in terms of support and resistance level. This is for corn. I think corn has been trading between the 20 cents range for a period of time. So 20 cents is an indication. If it can't break that, I think it's going to hit further down the next key support area, which is about 12 cents, based on the spread pair. Now, if you're looking at spreads, since the market tend to range between a very tight range, that's where a lot of traders will tend to deploy the mean reversion strategy. One thing to take note: mean reversion strategy doesn't always work. If you are in a trendy market, you know, the spread doesn't revert back to its mean. It usually follow the fundamentals shift in pretty much the outright contracts. Now, mean reversion sometimes will work in a market where fundamentals, you're pretty much balanced. Supply demand is balanced. There's no shock in either the demand side or the supply side. And market is actually on a sideways market. That's where mean reversion strategy will work most of the time. Because spreads, when it goes to extreme point, it tends to revert back to its mean. Because market will tend to adjust by itself. So potential trade setup is always look at the high ends and the low ends for particular spread pair. Identify where's the resistance, where's the support, and when it hit those extremes, that's usually indicate an opportunity for you to enter the position. But keep in mind, spread can break those levels easily, most of the time given a change of fundamentals. Okay, I'm just going to touch a little bit on soybean and corn spread, which is basically the intermarket spread. Now, I think majority of these are what we call a synthetic spread. There's no exchange listed spread when it looks at intercommodity. So I think the common ratio that common trade that a lot of marketplace is that the soybean to corn ratio. So you usually trade 1 lot soybean to 2 lots of corn. That's a ratio that we always use, and we always look at the price difference. So if you look at this table, you can clearly see that the ratio between soybean and corn has been always around the 2.4 to 2.5 times. And soybean is usually more expensive than corn. Obviously, there's also a period where corn is more expensive than soybean in history's perspective. And that's where, if you have seen that ratio, when it hits above 2.6 or 2.8, that indicates soybean is way more expensive than corn. So normally what traders will do is that they will take position to short the soybean market and to long corn. Now, when it goes below 2.2 times, that's where you start to notice corn is getting very expensive and soybean is getting very cheap. That's where you should be long soybean and short corn. So these are some of the common intermarket spread that we can use. Another one is also wheat and corn, but this is more of a seasonality play. So wheat and corn prices tend to move around May period, because if you look at the wheat season, that's where they go into the harvesting and end of the cycle. But corn is still pretty much uncertain at that point in time because they're in the planting season. So a lot of traders will tend to use, because prices will tend to react on the negative side. Wheat prices will tend to come down compared to corn. So that ratio will actually comes down. So a lot of traders will actually try to take position of a seasonality effect. But again, things can change because, weather can be in play, supply can be in play, demand dynamics can also change when you reach those periods. But based on seasonality, usually May period is where you tend to see weaker prices in wheat compared to corn. Okay, so I'm coming to the last part of my slides. Conclusion: trading spreads usually involves lower risk compared to outright trading, and usually it requires different dynamics. Now, the different dynamics here I always refer to is spread involves a lot of fundamental analysis. It does involve certain technical analysis, which I just highlighted earlier, but given the nature of spread that is very range, you usually trade on a very tight range, so it gives you a certain amount of opportunity, but you just have to be very careful when it does break above the key range levels. Now, there's obviously advanced strategy that one can deploy, but I'm not going to go too much or too deep in it. You know, and if you are trading spreads, always you must understand that, you know, you're just trading the price difference. And that doesn't mean that because of a lower risk profile, it's not going to be moving that much. You can clearly see the July-November soybean pair, it broke the 20 cents range and it actually rallied to, I think, the high of $1.20. So it can go very high if it does break its long-term average. Last but not least, you know, converting one leg of a calendar spread to an outright price is beneficial if both the prices are moving in tandem. If both prices are not moving in tandem, that's where it's not beneficial for you to convert your calendar spread to an outright position. Okay, so with that, I just want to leave you with this quote. You know, I think again, like to emphasize is, if you are someone new to the market, you want to start your journey in the market, always remember that, you know, every trading journey always involves risk management, and risk management is always a key when it comes to trading. So with that, I'm going to pass it to Ming Hui for the Q&A.
All right, thank you, David. Moving on to the Q&A segment, our first question for the night is, when trading these spread strategies, is it necessary to have a directional view of the underlying product?
Yes, that's a very good question. Yes, short answer is yes. You need to have a directional view, because if you look at the relationship between the outright contracts and the spread contracts, like shown you example like the soybean July-November pair spread against the July-November contract, outright changes, and that involved a change in the July-November spread pair as well. And if you have seen it, the moment it break the 20 cents range in the spread pair, and it actually coincide with a rally in the July contract. So in other words, you know, directional view or directional bias in the outright contract will tend to be displayed also in the spread pairs as well.
Right. The next question is, do you perform any back testing for these strategies? And are there any resources you can recommend for back testing?
Oh wow, that's a good question. Now, I do certain back tests, but in terms of platform that is available in the market to specifically back test certain pair sharing, spread pair sharing, I think it's very difficult. Unless you know, I until now I haven't come across a system that can allow you to specifically input certain parameters on a spread pair perspective. On outright, yes, you can definitely backtest it on a certain platform that's available in the market. For spread series is slightly different. For myself, I do backtest certain spread pairs, certain spread strategy. But given, you know, the low volatility, sometimes I would just have to, you know, be in the market, and from there probably you could manage your risk better. So you know, you don't really have to, you still need backtest, but I don't really need that much amount of effort compared to doing an outright.
Okay. Next question is, can I treat these spread strategies purely from a quantitative or statistical perspective without following fundamental news?
Wow. Yes. The short answer, yes, you can. But then again, statistical quantitative analysis by using spread, it does help in certain ways. Like I said, the properties of spread, uh, it does display mean reversion. So there's always a statistical arbitrage whenever you see there's a deviation from the mean, and from there you take your position. But again, I like to highlight spread dynamics, even though it tend to display statistical advantage at certain period of time, but you have to be very careful when fundamentals changes, because that will affect prices across the whole term structure. So you know, if you let's say for example, if you've seen corn March December has been trading between 20 cents range for 6 months, for example, it doesn't, historically speaking, that's the average, but you know, it doesn't tell you, you know, there's a tendency that it can break above that 20 cents range, and it can go much higher. So that's why we have to be careful whenever we want to look at statistical analysis when you are doing spreads, because things can change, and it can change fast, and spread prices will take into effect of those changes.
Okay, thank you, David. Due to time constraint, we'll take one last question from the audience, and that is, how do you calculate the take profit and stop loss levels to achieve the best risk to reward ratio?
Oh, that's a good question. Okay. I if you can use if you look at the first part series when I was talking about taking profit and managing your risk. So you can always work on ATR values, your average true range values. So say for example a particular spread pair, the July November soybean pair is doing ATR of let's say 20 cents. So whenever you enter that spread pair, you should be, let's say you work on a 2-to-1 risk to reward ratio. So you are targeting 40 cents profit and 20 cents as a loss aversion. So basically you can use ATR as a reference point. But again, when you look at spread and you look at the range, always look at the support and the resistance. So if I enter a particular point in a particular spread pair, look for where the next resistance are, and look at your support as if you are longing that thing. If you are longing that particular spread pair, your resistance is supposed to be your profit level, and your support should be your risk level. So that's also another reference that you can use whenever you're trading spreads.
All right, we will conclude the Q&A segment here. Thank you very much for the insights, David. And thank you very much, everybody, for your time tuning into this webinar tonight. We've received an overwhelming number of questions, and for those we didn't manage to answer tonight, we will do so via email. And we'll be sending everyone a link to today's webinar so you can watch it again if you'd like to. Do visit our website, philipfutures.com.sg, if you'd like to reach out to us, or indicate in the post-webinar survey if you would like for us to reach out to you. That's all for today. Thank you, David. Thank you, everyone, and goodbye.
Okay, thank you. Take care.